Hey, Tim, how is the price or interest rate I am charged related to the markets? Markets, I mean stock and bonds market. Well, for example, on a stock, that's ownership in a company. They might have 5,000 shares out there and you might own 10 shares. The valuation of the company, they call book value or whatnot. What is it worth? What do I think it's going to do because it's going to make more money or appreciate in value? That's when a buyer and seller agree on a going market, what I'm going to sell it for and what I'm willing to buy it for. So the market sets the price, much like it does on a lot of things in goods and services. Bonds work the same way. So when we're doing an actual interest rate, that's usually from Fannie Mae and Freddie Mac. Well, what do Fannie Mae and Freddie Mac do? They sell mortgage-backed securities on the bond market. The bond market, that's the investors who are buying for our retirement funds. They want something long term. They don't want the stocks and bonds to go up. They want something that's going to, in retirement, I want to make sure I'm getting that 5% stable rate of return. Those investors, bond investors, are out there selling these bonds. Well, if inflation's rearing its ugly head and I'm one of these buyers that's going to buy a bond, well, guess what? Maybe I don't want to buy it right now because I think inflation's rearing its ugly head. And I don't think 4.5 or 5% is going to be that great as compared to what I could get if I wait a little bit longer because I think inflation's there and I might be able to get 7% later. Now, let's say all of a sudden inflation starts coming out of the market. Well, I might say, wait a second. I want to buy even at these lower prices because inflation's going down. I may not be able to get this high interest rate for my rate of return for the future. And so what I'm going to do is I'm going to go ahead and be willing to take a lower price. So inflation has a big impact on what a buyer is willing to buy a bond at, which is the mortgage-backed securities interest rate. And Fannie Mae and Freddie Mac are submitting them out there for sale. And if they don't have any buyers, they have to raise the rate until they get buyers. If they have a lot of buyers, they can lower their rate because there's tons of buyers. That's how interest rates are established on the secondary market. So when you go to shop for a rate, and it says, oh, these real big difference in rates. Not really, because technically it's what Fannie Mae and Freddie Mac are setting the tone on what those interest rates are, because it's what buyers are willing to pay and what the seller, Fannie Mae and Freddie Mac, can actually sell them for. Tim Harrison, Straight Up Mortgage Talk, and this is HLC Team's Cornerstone Home Lending's educational series. Talk to you soon.